Do you want to do what everybody else is doing, or do you want to try to do better? Your money and your health are two things. If you're delegating to the wrong person and you don't know it, you don't come back from those types of mistakes. In the mid-90s, I came across Jack Schwager's Market Wizards books, and I just got hooked. How I make money, I do not care, but I think if you put on blinders and you're like, I invest for dividends, I think you're gonna end up with mediocre results. Heads, I win a lot. Tails, I lose a little. You don't have to be right that often. Keep your eye open to what's going on and then use second and third order thinking. We teach an approach that I call HEAT: hedges, edges, asymmetrical risk, and themes. It's not do what everybody else does, because if it was, the Forbes 400 would be the Forbes 40,000. Where I think the next big opportunity is.
Investors, welcome back to another go-round of Masters of the Market. Joining me this week is the CEO of Tuttle Capital Management, Mathew Tuttle. So Mathew, I want to first and foremost welcome you to Masters of the Market and get jump-started here with our first question, which is, what's your story and how exactly did you get to where you are today?
So my story started in 8th grade. We did a stock market project where we had a mythical, I think it was $10,000 to invest, and we had to pretend buy stocks and justify our rationale. And I just got hooked. I mean, up until that point, I wanted to be either a doctor, a firefighter, or a policeman. And after that, I was like, yeah, I want to be in markets. And this was like 1981, 1982. So, I was hooked on investing. We put together, an investment club in college, investing on takeover speculation. I was lucky enough to be in college from 86 to 90, so the height of the takeover boom. Had a lot of fun with that. Then in the mid-90s, I came across Jack Schwager's Market Wizards books. At the same time, I was in business school, and I had a professor teaching modern portfolio theory kind of pull me aside, and he's like, you know what, all this stuff is bull. I have to teach it, but this doesn't work. Hey, let me show you this. And he showed me an adaptive moving average model that he had designed for currencies that he sold to some hedge fund. And, in seeing that, and then I deconstructed it, in reading through some of the people in the Market Wizards book, in seeing, all these guys who had made so much money in the markets, all different ways, but the one thing every one of them had in common is they had an edge. And so that just really got me started on, this whole process of really learning how markets work, how to be successful in markets, because it's not do what everybody else does. Because if it was, the Forbes 400 would be the Forbes 40,000. You don't get successful at anything just saying, hey, I'm going to do what everyone else is doing. You've got to find, where your edge is. And, that's where I started, and that's what's driven me and what continues to drive me.
And in terms of Tuttle Capital Management, how did you get there? How did that just come to be?
Yeah, I had a couple of jobs in finance, not where I wanted to be. Went to business school to try to change course, ended up, again, not exactly where I wanted to be, but, as a stockbroker in the 90s, seeing what was going on with the internet boom and, seeing these opportunities to make generational wealth and seeing what brokers were doing to people, which was not helping investors make generational wealth. It was helping brokers make generational wealth. Then went to a couple of insurance companies thinking maybe that environment would be better. It was not. In 2003, someone gave me a book, Start Your Own RIA. I read it, and within maybe a month, I started my own RIA, started working with clients. That was 2003. By around 2012, I started to have other RIAs come to me and be like, hey, Matt, we see what you're doing. Can you manage money for our clients? And that's what I always wanted to do. So I was like, yeah, I'm in. One of the guys came to me, he's like, but wait, you're right down the street. We're competitors. How do we deal with that? I was like, you know what? I'll set up a money management firm. And you go to my money management website. I won't say anything about taking clients. He's like, all right, cool. So I had two firms. At some point along the way, 2015-ish, 16, give or take, I just said, you know what, I'm going to focus on the money management side. And, there was a family office I was working with at the time, gave them my wealth management firm. In 2015, I was also getting frustrated. We were trading separately managed accounts for people. And we were pretty much forced to trade on all the custodial platforms. And I'd go to conferences and I'd meet market makers who'd be like, yeah, trade with us. We can do this. We can do this. We can do this. I'm like, man, that's way better than what I have, but I can't work with you. One of them said, why don't you just start an ETF and put all your strategies in an ETF? And again, when someone gives me a good idea, I move quick. And, probably within 4 months, we had our first ETF. That was 2015. I've been popping out ETFs for almost 10 years now.
Before we get into Tuttle Capital Management ETFs, because I got a boatload of questions for you about them, I want to talk a little bit about Wall Street. Just based on your experience on Wall Street and your dream to ultimately help investors, what was it about what you were seeing, on Wall Street that pushed you away from the street? Can Wall Street actually be trusted, or is that a myth?
No, Wall Street's like every other industry. They don't have your best interests at heart. They have theirs. And, everything they're doing is about them making money, not you making money. Why? And you see that in every industry. Now you've got people pushing back on the food industry, the drug industry. Why it's not, you don't see as much pushback on Wall Street as the market goes up 90% of the time. So, most people out there following the traditional advice are making money. They're just, they're not going anywhere. And then they have their lost decades, 2000 to 2010. 2008 to 2009 down 60%. So, people aren't really going anywhere. They're not doing, they're not living up to their potential. They're not losing money over time unless they're doing stupid stuff. But just, the things you would see, like, one thing that's always stuck with me is as a young broker, we're sitting there and this one, advanced broker is holding court telling a story of how he took a client who had a $40,000 portfolio and generated $40,000 in commissions. And everyone's asking, how did you do? No one's at, how'd the client do? To me, hey, how'd the client do with all that? No one's interested in that. It's like, hey, how'd you do it? That's a lot of the stuff that's out there. So really, my passion comes from two angles. Number one is Wall Street is unkind to the uneducated. People have to educate yourselves. We're in a delegation society. If your appendix is ruptured, you're not taking it out yourself. You may, I'm not changing my own oil. Yeah, and there are a lot of things that we delegate that we can just delegate. And if we delegate it to a moron or somebody who's unethical, not that big a deal. We can recover from that. Your money and your health are two things. If you're delegating to the wrong person and you don't know it, you don't come back from those types of mistakes. So you need to be educated. And then I also want to provide investors with an alternative. It's not easy. Anything that, can generate such rewards is not going to be easy. If it was easy, everybody would do it. But, we've come up with a process. I'm working on a book about it. To me, blows away everything else that's out there. So, those are the two things that really drive me.
What was the spark of inspiration for you in terms of helping the everyday average investor? Because it seems like it was there before Wall Street. It remained there after Wall Street. And even till today with the book that you're going to have coming out.
Just really seeing what's going on and how people, are being lied to, or, there are good advisors who just, aren't that knowledgeable. Just seeing all the stuff that was out there. And I come from a family of teachers. That's probably it. And, I see stuff going on and it just bothers me. And then I see the sources of education. Like, all right, Matt, I need to get educated. I'm going to go watch CNBC. Well, all right, here's Jim Cramer. Hey, Jim, what do you think the market's going to do? Why don't you ask him about what he told you yesterday that was totally wrong? You're not going to hold him accountable. Or, Kathy Wood is the next Warren Buffett. There will never be another. Warren Buffett isn't even Warren Buffett anymore. The market is structurally different. There'll never be another Warren Buffett. So, where do you go now for education? It's not easy.
This begs the question, is your strongest of recommendations then for all of us to actually build our own portfolios and do our own money management?
If you can. And again, it's not easy and you got to be educated. I mean, we teach an approach that I call HEAT: hedges, edges, asymmetrical risk, and themes. It's about being agnostic between being long and short, which is not easy for everybody. It's having hedges in place most of the time because bad things happen in the market. And, while, you're a long-term investor, I mean, okay, you had $1 million in October of 07, and by March of 09, you have $400,000. Hey, you're a long-term investor, don't worry. That sucks. I mean, I'm going to worry about that. Finding edges in the market, either through strategies or structural edges. There are products out there that have structural edges, designing things with asymmetrical risk and figuring out, what are going to be the long-term themes. Again, it's not easy, but it is doable. But if you don't have time, you're kind of stuck with what's out there. I mean, time and willingness to put in the effort. Again, it's not something, hey, I'm going to take 5 minutes and I'm an expert. I mean, you're out there competing. One of my kids, all A's, great school, works at a big hedge fund. I don't want to compete with that guy. But I mean, you're out there competing with guys like that.
Now, let's say we have an investor who's looking to get started. They're at least up to the challenge, even though we know it's not easy, much easier said than done. Where should the investor start? And I'll give you two avatars: an investor perhaps in their early 20s and an investor, for my viewership here, in their elder 30s or 40s.
So 20s is awesome because 20s, you can make mistakes. So give you a great example. So I graduated college in 90. In college, we'd been trading based on takeover speculation. Michael Milken in the late 80s, companies were being taken over left and right. And if you read in the Wall Street Journal one day, hey, XYZ, moved up 5% on takeover speculation, we're just going to buy call options in it. And the next day it's announced they're being taken over. It was amazingly easy, like taking candy from a baby. 1990 comes, Milken gets thrown in jail. Takeover boom has ended. I'm trying to do the same thing. XYZ is getting taken over. Boom, I'm buying options. Doesn't happen. I ended up, I think, losing like $20,000, which at the time sucked because that was almost all I had. But it was a great learning lesson. And I mean, I've had 35 years to come back from it. I don't even care about that. That was a great lesson. So in your 20s, you can learn. I think risk management is first and foremost. Learn how to design your trades for asymmetrical risk. Heads you win, tails you lose a little. So I would look at everything I was doing from that standpoint. What's the worst case scenario? How much can I lose on this trade? How much can I gain? And I don't go into anything or do anything where it's not multiples. So I'm a big fan of options. Because in options, I can say my position size is whatever, let's say $1,000. So I'm going to buy, when I think something's going up, I'm going to buy a call option for $1,000. What's my risk? It's $1,000. Exactly, I know it. Versus, let's say I put $10,000 in a stock. I mean, what's my risk there? I mean, yeah, it can go under, but you're not expecting it goes under. Look at Super Micro Systems yesterday, which I happened to have puts on, which was nice. Went down 14% because out of the blue Justice Department thing. So I think focus on the risk side first and foremost, and then worry about the return side. But I would focus risk. And in your 20s, that's great because you can screw it up a bunch of times and still be fine down the road.
Some of the best lessons, I'm sure, coming from everybody's 20s. But moving into your 30s or 40s, I mean, I would take it you need to be a little bit more risk adverse at this point. You're losing some time
I
there on the
mean,
watch.
you always need to be risk averse. There are ways to make lots of money in the markets being risk averse. You've always got to be risk averse. At every age, always focus on the risk, which again was not what I was doing in my 20s. I was, returns, 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 returns. And I could have structured my trades in such a way that if I were wrong, I didn't lose any money. So and this gets complicated, but just to give you an idea, one of my favorite trades is if I think something is going up, I'll use options to do a call credit spread, use that credit to then buy, a levered ETF, or if I'm using an ETF, maybe one of the holdings. And that structure, if whatever I'm buying goes up a lot, I have unlimited upside. If I'm wrong and it goes down, I break even. And if it's flat, I know exactly what my maximum loss is. And I like knowing in every trade what's my maximum loss. If I diversify my portfolio, not by asset class, that's stupid, by methodology, then I pretty much know what I'm dealing with. I also, and again, I don't know how technical you want to get, 80%, give or take, typically 80 to 85% of my portfolio is in T-bills. And I use the options to lever, and I can have the same returns of a 100% stock invested portfolio. But I know with 80, 85% of my portfolio in T-bills, my worst case scenario is a 15% loss. And if I'm diversified by methodology, the chances of that happening is extremely, extremely rare.
Today we have ETFs. I mean, literally for any type of investor that's out there, even options-oriented investors. And the whole idea of the ETF really gives any investor a lot of comfortability. I'm curious to know from your perspective, is the ETF route worth it?
The ETF route is worth it if you use it appropriately. 90, let's say 5% of ETFs out there suck, but you can still use them. So give you an example, the VIX exchange traded products. They are structurally garbage the way that they're designed because they invest in futures. And again, I don't want to get too technical, but there's something called contango. They're designed to go to zero. So one thing that we do is like 90% of the time, I own puts on those ETFs. It's a structural edge. Sector ETFs, most of the big sector ETFs, if you look at what they own, they suck. But they're great trading vehicles. So we use them as such. The beauty though of ETFs is you've got so many different types of tools. So, I mean, the thing we're known for at the moment, we're doing a bunch of other stuff, is levered and inverse. And, those are great trading tools. One of the reasons I do levered and inverse is I love using levered and inverse. So I like launching stuff that I want to use as well. Those are great tools depending on what you're trying to accomplish.
Would you recommend jumping right into ETFs at first, or actually going in the opposite direction and picking some individual stocks? Or does it matter on age, risk tolerance, so on and so forth?
So I am a big believer in trying to identify what the next themes are likely to be, and then trying to use second and third order thinking along those themes. That is better done in individual names. And again, because a lot of you, so like the big theme right now that everyone knows about is AI. But if you look at most of the AI ETFs, they're all FANG and friends. NVIDIA and all the companies that you could just get buying the Qs. I don't think there's any alpha there. Where I think the next big opportunity is in AI power generation. There's no direct play on that yet. Maybe there will be soon. So if you've got the time, I think it is valuable to look at individual names. If you don't, then you really got to use ETFs. And, it's not perfect, but, if I think AI is a great theme and I'm in an ETF for AI that, again, is not the way I would have designed it, but it's got a lot of NVIDIA in it, you're doing all right.
Now, if an investor is trying their best to build a portfolio on their own, and this is the great debate out there on YouTube and across social media, what's the ideal number of positions that you should have in your portfolio? Because some are arguing, stay lean, maybe 7 to 10 positions. And then we got on the other side, some investors with 70 plus positions, which to me is like, just go down the ETF route if that's where you are.
So it depends on a lot of things. I mean, it depends on your portfolio size, for example. I talk about asymmetrical risk, managing risk. If I have $1 million portfolio and it's in 5 stocks, I'm sitting on a ton of volatility and a ton of risk. To me, no, I'm not doing that. But there's also, how many stocks can you manage and watch? If you're working from 9:30 to 4 and you're managing your own portfolio and your own stocks, how do you have 70 names? That's going to be somewhat difficult. And then, at some point you're like, am I any different than the S&P 500? How are you going to analyze 70 names? So, for me, I used to do a lot of discretionary trading. And when I was doing discretionary trading, there are only so many names you can do. Now I don't have the time and my portfolio is too big. I do a lot of systematic trading. And the way the systems are set up is either we're buying around the open, or we're buying and selling, or buying and selling at the close, which for me means I just got to be watching stuff around the open. I got to be watching stuff around the close, and during the day I can concentrate on my day job. So it really depends. What I would not do is see, Ari is doing it this way, so I'm going to do it like that. Well, but you don't know anything about Ari. You don't know his situation. And I think, what's going on Twitter is great. I think that's the biggest mistake people make. They see, their favorite furor on Twitter doing it this way, and they're copying that guy. And his situation is totally different than yours. You've got to take what he's doing and adapt it to you.
I love that you said that, because a lot of the times I'm even sharing that, on my personal channel, where I'm saying, hey, this is my investor profile, and very likely it's not going to match yours. I'd love to ask you, how does one go about even formulating their own investor profile to get to know themselves and how they should be investing?
So, it takes time. Certainly mistakes will help format it. Your personal psychology. So for example, I am a counter trend guy. I am very comfortable buying dips. I am not comfortable buying something that's gone up 10%. Now, sometimes that kicks me in the butt where I'm watching a stock and I'm waiting for a dip. Especially in this AI power, stuff, CEG the other day went up, 23%. I'm sitting there watching, waiting for a dip, and then it's up 23%. All right. Yeah, I should have just bought the thing, but I've got a mental block to buying something that's already gone up. I'm waiting for it to dip back into support. That's me. Someone else is going to be a trend follower and be like, hey, I want to buy stuff that's going up. Stuff that's going down scares me. So there's just so much that goes into it. And I think it takes time, experience, knowledge. Back in 1990, I probably didn't even know counter trend existed. And, you start reading and you come across guys like Larry Connors who, pioneered, shorter term RSIs and CRSI and you start reading stuff and you're like, that resonates with me. And then you're, reading other things. You're like, that seems a little risky to me. I don't think I could do that.
Now, when it comes to red flags, let's say we're looking at a stock and we want to pick out the red flags so we know to actually stay away from it. Or on the opposite end here, we got the green flags go up. Can you give us some of the fundamentals that you look into? What red flags do you watch out for, and what green flags mean, you got the green light now to go?
So I'm picking stocks one of two ways. Either I've got a system that I use, and again, it's going to be a counter trend type of system. For me, I use a couple things. I use something called internal bar strength. I use Williams % R. I use RSI. And then I also use, RSI in pullbacks of stocks that have made new highs. So I'm not going to override the system. If the system says buy XYZ and I'm sitting there thinking, I don't know, this, but what I'm going to do is I'm going to design the trade with asymmetrical risk. So again, going back to my options example, let's say it says, hey, buy XYZ. I'm like, oh man, I don't like XYZ. But all right, I'm going to put $1,000 into a call option. Worst case scenario, I was right. XYZ sucks. I lost $1,000. And again, whatever that number is for you, if I had a $10,000 portfolio, I'm not putting $1,000 into an option position. But so I'm just giving that as an example. I've got fixed risk. On the other side, I'm looking at the themes, and the problem with themes, and I used to be a proponent, trade everything. The problem with themes is you don't know. Like my CEG example, you don't know when Microsoft is going to enter into a deal with CEG and it's going to pop 23%. And if I'm using, RSI on CEG, RSI is not going to know. RSI is not smart. It's just saying, oh, it's oversold. So with the thematic stuff, you've just got to be there. You have a diversified portfolio of themes and you've got fixed risk. So again, I like to use options. Another way you can do it, if you're like, Matt, I don't like to use options, buy the stock and buy a put. You've still got fixed risk that way. I've got my downside covered. I know my worst case scenario. I've got unlimited upside. I don't worry as much about red flags and green flags.
And on a dividend end, there is, at least in the dividend community, a tremendous amount of safety in just going towards dividend stocks and quote unquote collecting passive income. The question I have for you is, just investing into dividend stocks and waiting for those dividends to hit your account, is that going to ultimately yield us, the portfolios we're really looking for, or is this kind of a pipe dream?
So I would push back on that. And sometimes, I used to give talks and someone, dividends. I'd be like, all right, here's $20. Doesn't matter to you whether it's dividends, interest, or capital gains. No, it's $20. Here you go. I would never invest just for dividends. Just the fact that a company pays a dividend or has raised their dividend does not make that a good company. I would invest to make money. How I make money, I do not care. But I think if you put on blinders and you're like, I invest for dividends, I think you're going to end up with mediocre results. We run one ETF, for example, the Laffer-Tangler Equity Income Fund. It buys dividend-paying stocks. It does not buy dividend-paying stocks just because they pay a dividend. So it's run by Nancy Tangler. One of the things she looks for is really, really good companies that, oh, by the way, they also happen to pay a dividend. So it's not managed for yield. I have no idea what the yield is. I don't care what the yield is. What I like about it is one of her big themes is old economy companies that are going to benefit from AI. Because to me, there are a bunch of themes I'm looking at right now, but AI is number one. Because AI, and again, I lived through the internet bubble, that was a game changer. AI has the potential to be a game changer even more. Unless AI kills us all, it probably will. And if it kills us all, we don't care.
And it doesn't matter either way.
Right, exactly.
I want to talk a little bit about the Tuttle Capital Management ETFs. I'll ask you first and foremost, what's one of the most popular ETFs that you have over at Tuttle Capital Management?
So the biggest right now is NVDX, 2x long NVIDIA. For obvious reasons, NVIDIA is, the poster child of AI. You can't do AI right now without NVIDIA's chips. And, and as an aside, I love NVIDIA. When people, NVIDIA is overvalued, again, I remember back in the 90s, and I remember as a broker in the 90s, having conversations with people like it makes no sense that Amazon is worth more than Barnes and Noble and Borders combined. Be like, that's just crazy. Now looking back on it, it's like Amazon was undervalued. But I didn't realize at that point that Amazon was a game changer. NVIDIA, same deal. Oh yeah, overvalued. Not if it's a game changer. So, that's the most popular. What is moving up? We just launched MSTU, which is 2X MicroStrategy. It's got 82 million in it, and it's only been out for like a week. And I don't know if you're going to be recorded. This is pre-market. Right now, it's traded $4 million, and it's 8:30. And normally, our biggest trading one pre-market is NVDX. It's only traded 3.6. So I have a feeling we're going to see some more money flow into MicroStrategy today.
I loved how you talk about the game changer, right? There's exceptions for certain game changers. And I'm curious to know from your perspective, is there a way to find out which opportunities are the game changers? Like, is there a way we could have known about Amazon? I mean, Jeff Bezos, of course, was betting big on it. It was his deal. But at the end of the day, I mean, dozens of people said no to Jeff Bezos. And I think it was like the 10, right, who stuck with him ultimately hit the home runs. But how do we know?
So you do a couple of things when it comes to themes. First off, you open your eyes. Forget about kind of, what Wall Street is telling you and open your eyes. So AI is obvious. The other themes that, we're laser focused on, below the radar theme, self-defense. You've got crime going up, up, and up. You've got people feeling less safe. I've got, one of my kids, my daughter is in New York City. She was chased the other day by some guy with a stick. We got her a taser. I could swear I got her pepper spray, even though she says that she doesn't have it. But people are feeling less and less safe. They're going to take self-defense into their own hands. We launched an ETF for that, GUNZ, the self-defense theme. That's a theme that I think is out there. Argentina is an interesting one where you've got a reformer who's come in, who's been able to cut inflation and turn around an economy that's been in the tank for as long as I've probably been alive. And, so the Argentine stocks. The other one is the weight loss drugs, where, and personally, and I mean, you look like you're in good shape. I mean, personally, I think it's an aberration. Obesity, the whole epidemic of obesity is not because we don't have enough Ozempic in our lives. But Americans are lazy. If I tell you, hey, stop eating the food you like eating and go to the gym, or you can just take the shot, you're going to take the shot. Keep your eye open to what's going on, and then use second and third order thinking. So AI, NVIDIA is obvious. But let's say I said, hey, Ari, here's a NVIDIA chip. Go do AI. You're like, but I can't. I need the hardware. I need a place to put the servers, and I need a way to power the server. Okay? What companies do those things? And, that's kind of the next generation. Then you look kind of third order, right? Who's going to get hurt? So, there's a company out there, Chegg, for example, who, you have to pay to get information that I can now go to Chat GPT and get for free. How does Chegg stay in business? What other companies are like that sell you information that you can get? Or on the weight loss drugs, what about the gyms? I mean, if I don't have to go to, personally, I hate working out. If I don't have to go to the gym anymore, I'm not going to the gym. I don't enjoy that. So, what's going to happen with gym memberships? So it's just, it's kind of like Peter Lynch back in the 80s wrote a book, One Up on Wall Street. And his idea was invest in what you know. So, he's going to, the department store. His wife loves Legs pantyhose. He's eating at Brugger's Bagels. There's a line out the door. It's somewhat along those lines. Just keep your eyes open and see what's going on around you.
Where do you think a lot of investors are going south with this type of strategy? Because, oftentimes we really do. We turn on, at least at this point in time, YouTube or go to X, Twitter, and we very quickly jump on a trend. Are we just not taking the next, steps worth of research seriously? Or where do we get lost in this? Because a lot of investors seem to be losing money when they go after the trends.
So again, I'll go back to designing asymmetrical risk. Come up with your own methodology. So, I'm on Twitter all the time. I mean, I follow the gurus who, hey, I'm buying this, I'm buying this, I'm buying this. I very rarely will tail someone in those unless it's a name on one of the themes that I like. So, the other day, a guy I follow mentioned, a name of a company. It was tangential to the AI theme. It was a company I wasn't familiar with. I took a look, like, yeah, I'm going to buy that. And my options are up like 50%. And again, fixed risk. If it's wrong, it's a very small loss. I don't really care. And if it's right, I've got, unlimited upside, and so far so good. And so, I'll do that from time to time. But just blindly following someone, I don't know you're gonna have the results. You don't know what kind of results they're having either. Unless everything is out there in an auditable way where you can see. But even then, past performance doesn't predict future results. Which brings me to another topic. I mean, we also like to teach people forward-looking due diligence, which is looking at what happened in the past, but then extrapolating it. All right, you sucked or you didn't suck, but why will those returns persist? But really, it's the risk side. Focus on the risk side first. Set up trades for asymmetrical return. Again, if you set up your trades, heads I win a lot, tails I lose a little, you don't have to be right that often. In fact, depending on there are a lot of people kicking around out there that were right once. Like the guys in 2008 who called the housing bubble, they don't ever have to be right again and I don't think Michael Burry has, and I don't think John Paulson has. But those guys are billionaires because they were right once, and they set it up asymmetrically.
Almost every other week, I see something from Michael Burry saying the next crash, the next X, the next
Y.
Right,
he's called 50 of the last 2 crashes. So
yeah. When it comes to macros, do macroeconomics really matter all that much? Because for at least from what you're sharing now, it sounds like you're more into the trends, less so the macros. A lot of people, we just had Jerome Powell come out, cut interest rates, questioning what that means for them in the future. Does it matter at the end of the day?
It depends on your portfolio. And for me, I've designed my portfolio, so I don't care. Again, like I said, 85% of my portfolio is in T-bills. I don't like interest rates going down because I'm going to earn less on them, but not that much less. And my options, I've got puts on some names. I've got calls on other names. Right now, I think I've got calls on the VIX. Yeah, I do. I've got calls on the VIX. So, if the market opens up down 10%, yeah, all right. That sucks, but I'm going to buy the dip. If it goes up 10%, great. So if you've got your portfolio set up that way, it doesn't really matter. Certainly you would prefer the Fed lowering interest rates because there are times when making money is easier. So, it's one thing to manage your risk. So, do I care if the market crashes 20%? No, I don't, because, my portfolio is going to be fine. But am I going to make a ton of money? Probably not, unless sometimes you're just positioned right. Like yesterday, I didn't know the Justice Department was going to come after SMCI. I have a model that looks at stuff that gets way extended to the upside and then has another jump, and we buy puts on it. And I happen to have puts on SMCI, and I'm looking at my portfolio yesterday, the total, like, man, I'm doing really well today. Oh, SMCI, awesome.
Now, let's say an investor who's watching perhaps right now heads over to Tuttle Capital Management's website. They see some of the ETFs, and they're trying to compare them against, an ETF from Vanguard or Charles Schwab. What would be the differentiator? Like, why go with a Tuttle Capital Management ETF?
What we want to do is we want to do a couple of things, and it goes back to kind of that HEAT acronym. I want to provide ways for you to be able to hedge, and we have some stuff coming in that regard. I have inverse ETFs now. One of the other themes I really like is we've got SKRE, which is inverse regional banks. I think regional banks are a ticking time bomb, which is why I think, it may behoove people to have some inverse regional bank in their portfolio, because at some point this commercial real estate thing is going to blow up. So, we want to give you tools to hedge. We want to give you tools where there are edges. So we've got, for example, Brendan Wood Top Gun ETF. And I just did a webinar on that. It's on my YouTube channel. But the idea is they survey all the top money managers out there. And, we're all focused on, hey, what did Warren Buffett own at the end of the quarter? What Brendan Wood does is find out, hey, what's Warren Buffett going to own over the next 3 months? And they're getting that information and compiling it. To me, that's an edge. We want to help people construct things for asymmetrical risk. So we've got our 2X stuff that, you can use. And again, I use the options on those names. And then we want to have the themes. So we've got guns, which is our self-defense theme. I've got ESGX, which is my politically neutral theme. I think companies that stay out of politics entirely And we've got research that they've done better than companies that don't. And I think that will continue. You've got a whole bunch of companies out there right now. You can argue, well, they're doing the right thing or the wrong thing. But what they're doing is they've managed to piss off 100% of the people. And so ESGX buys companies that just fly under the radar screen. Hey, I make widgets. All we do is make widgets. We're focused on making widgets. We're making them better. We're making them, we just want to make our shareholders money. So that's the areas we're focused on. If you want broad-based market exposure, broad-based sector exposure, passive stuff, Vanguard, BlackRock, State Street, boom, you're done. What we're going to do is give you tools to, try to help you do better.
Sure. I want to put you on the hot seat with this next question. It's a question I always like to ask anybody who's a CEO, CIO, and the alike. When it comes to fees, because everybody's always talking about fees, right? If I go with Vanguard, I might get a 0.03% fee. But then I can come to a Tuttle Capital Management or any of these other smaller firms, and the fee's bigger. What would you say is the answer and how to combat that? And in the long term, does it really matter?
It depends. Fees matter apples to apples, not apples to oranges. So when I started out in the brokerage industry, it was where these asset allocation, separately managed accounts were like the most popular thing. And, you'd come in, they'd construct an asset allocation and then hire money managers and charge you 3%. Then people said, well, hey, we'll just, we'll go into ETFs and it'll be this. And the fees kept coming down. Did fees matter in that standpoint? Yeah, fees totally mattered. An asset allocation portfolio is an asset allocation portfolio. If you pay 3% for one and, 25 basis points for the other, 25 basis points is better. The tools and the structures and the things that we're bringing to the table are entirely different. And they are tools, structures, and things that require a lot of work. A monkey can run the S&P 500. The amount of work we're putting in on our levered and inverse every day is insane. The work that the Brendan Wood guys, do to come up with their Top Gun names. The work that my index guy does on ESGX and guns. It's just entirely different. We're giving you different exposures. And in my mind, we're giving you the ability, if you use things right and, caveats, past performance doesn't predict future results, we're giving you the tools to be able to do pretty well. So, I don't think you can look at fees in a vacuum.
Now, is there a case for going, with ETFs such as the ones that you have at Tuttle Capital Management versus the S&P?
So, again, it comes down to, do you want to do what everybody else is doing? Or do you want to try to do better than what everyone else is doing? And what I want to do is I want to provide tools. I also want to do more education. So I'm glad we're doing this on how to use those tools. Will you be fine if you just buy the S&P 500? Probably, if you don't do anything stupid. But, it also comes down to timing. I remember, back in 2002, meeting clients or potential clients and be like, yeah, I was all ready to retire in 2000. Now I got to work another 5 years. 2009, same deal. Yeah, I was all ready to retire. So, it's one thing to have a 2000 to 2002 or a lost decade, 2000 to 2010 or 2008 in your 20s. It's another thing to have it in your 60s. Yeah, if you hold on to the S&P for 20 years, will you be fine? Yeah. If you can stomach that ride, yeah, you'll be okay. Can you do better than that if you put in the work? I think you can. Up to you.
Now, quite a few times you've mentioned some of the legends of Wall Street. And I'd love to know if you were to grab a beer or go out to dinner with one of those legends of Wall Street, perhaps an icon for yourself, who would it be? And what exactly would the conversation be like?
Ooh, that's a tough one because I already deal with some. So, Larry Connors, I brought up. Larry and I are friends. We talk all the time. We're talking today, actually, about some stuff. And he's a guy, I love to hear his thoughts on markets, the way he looks at things. Another one who we're actually launching an ETF for in the next couple of months is Larry Benedict. He's one of the living market wizards. He's an options guy. So near and dear to my heart when he's like, hey, Matt, I want to launch an ETF. Like, I'm in. I want to be part of that ETF. Another guy who I talk to a lot is Jerry Parker. We're not involved in his ETFs, but I'm a big fan. Probably the one from the Market Wizards books that had the most influence on me was Gil Blake. And I don't even know if that guy's still alive, but he's the one guy, the one wizard I don't know that I'd love to sit down and talk to him about, because he came up with a methodology that I then went in the 90s and tested and was like, holy crap. There's this edge here. Now, by the time I was testing it, you couldn't use it anymore. But, just the fact he had found this edge, and that, of all the things I talked about, finding edges is the most fascinating thing to me. Because if you can find an edge, especially an edge that can't be arbed out, I think that's the coolest thing.
Now, you have experience from Wall Street to opening up your own firm and really just having your hand in the game constantly. I'm curious to know, knowing everything that you know now, if you were to go back to the beginning, the early stages of Mathew Tuttle's career in investing, what would be one or two things you'd tweak to better set yourself up today?
I mean, not one or two things. I'd tweak everything. I mean, the money I lost when I was 21, I mean, that was, looking back, it's like, man, that was stupid. What was I? I mean, if I took my methodology now to when I was 21, I mean, I'd be a billionaire right now. I'd be a multi-billionaire right now. That'd be insane. But, and also, I mean, same in business. I mean, so many mistakes when I was younger to get to a point now where, I mean, this is awesome. We have almost 1.4 billion. We're launching new ETFs. We're launching ETFs I like. We're doing a lot of cool stuff. I just wish I could have gotten here a lot sooner. And so, I'd love to go back to my old self and just, beat me up a little bit and be like, come on, man, what are you thinking?
What pieces of advice would you give some of those younger bucks who might be out there right now listening to this interview, trying to follow suit?
Risk, and risk on the investment side. On the business side, no sunk cost mentality. And, that's something that has always served me well. I'll go down a path and maybe I'll spend hundreds of thousands of dollars on the path. Once I realize this isn't going to work, doesn't matter. Yeah, I spent 3 years on it. I spent hundreds of thousands. It's not going to work. I'm going to go to the next thing. The other thing that served me well, and it's risky, but it's ready, fire, aim. So someone will bring me an ETF idea, I'll launch it. And, then, 3 months after launch, I might realize, what, that wasn't such a great idea. And then I got hey, I told you so. Yeah, all right. I'll shut it down. But I think, if you're sitting there, paralysis by analysis, and, and I think a lot of ETF providers, do that. And, so fine, we'll beat you to that idea. And we have. I mean, we've done a lot of firsts in the ETF space. And I've had people come to me, after we did something, I was like, man, I was going to do that. I just never got around to it. I'm like, second it was brought to me, I'm like, this is cool. Let's go. And let's see. And I think, think outside the box. Again, nobody ever got rich doing what everyone else is doing. So when I look at the ETF space and what we want to do next, I'm trying to figure out what is it that nobody is doing. What can I do first? We got 2X Netflix coming out today. It'll be the first 2X Netflix. I mean, that's small fry, but we were the first 2X NVIDIA and first 2X Tesla. We got over $1 billion in those products right now. So, those are the words of advice I give people.
It really sounds like it comes down to finding an edge for yourself as an investor. And I think another big, issue or dilemma that a lot of investors run into is dealing with emotion, whether it's to sell or, on a hype stock to buy immediately. How do we mitigate emotion and stay steady on the trigger finger, if you will?
So a few things. I mean, first off, I will go back and beat a dead horse, the risk side, asymmetrical return. Make it so that if you're wrong on a trade, it doesn't hurt. That's first and foremost. Try to be as systematic as possible because again, all right, I'm not going to override the system. System is saying we're buying XYZ, we're buying XYZ, and then make whatever your methodology is fit, who you are. If I had, if everything I was doing was trend following, I'd be emotional as crazy because that's not my DNA. I'm a counter trend guy. If I'm buying everything I'm buying is already up 10%, that's going to move all over the place. That's going to scare the heck out of me. That's not where my DNA is.
Is there only one true way to figure out, your investor profile in that case? Like just get started, jump in, try trial and error, or should we be reading first?
In a lot of things, it's like I said before, ready, fire, aim. Come up with what you think it is and, and have a test portfolio. I mean, if you're sitting there 55, $1 million, hey, I'm going to put my whole million and see how it goes. No, don't do that. Take 10,000, test it, see how things work, read, watch podcasts, learn from a bunch of guys out there, but don't, hey, Tuttle does it this way, I'm going to do that exactly. Well, no, you're not me. What works for me is not going to work for you, but see what all those guys are doing and take pieces of that as you see fit.
We are winding down on 2024, a couple months left to go here. And I'd love to catch what you think is on the radar for us in terms of the next few months, how we're going to close out the year. And to the best that you can, I mean, no one can predict the future, but what do you think 2025 is going to look like?
So rest of this year, in a vacuum, you don't fight the Fed. Fed's lowering interest rates. I think that's good for the market. You have an election coming up. I don't think just an election means anything for the stock market. I don't believe that presidents impact markets. Presidents will impact names and sectors. So, certainly if you're trading like DJT or, Geo, or you're trading clean energy names, who wins matters. But if you're looking at SPY, I don't think who wins matters. Now, could there be turbulence, things out of the blue? This has been an election season like no other. Things could come out of left field, which is why I believe you need to be hedged because who knows what could happen. But in a vacuum, don't fight the Fed. 2025, I hope all this turbulence is behind us. You've got the Fed lowering interest rates. Let's go. I mean, that should be good for markets. You're going to continue to have advances in AI. And again, like I said, if it doesn't kill us, it will make us stronger. But I am a little bit worried of something coming out of left field here. No idea what that might be, but this has been a crazy couple of months and I can't imagine the craziness is going to wind down.
Now, what I've been seeing, at least rather recently, is some headlines with recession in there. And the Federal Reserve cut the interest rates too fast now. Of course, it's always designed to scare us. And I'm in the camp where I think we're going to get a bit of a bullish run, some momentum building from these rate cuts. But now that I'm seeing all the headlines here with recession, do you think a recession's on the horizon for us in the near term?
So I think it depends on your definition. I think the average consumer out there, if you said, hey, we are in a recession, they would say yes. Because I think, inflation, all the stuff that happened during COVID, I think the average consumer out there is stretched at best and already broken most likely. And you see numbers of auto loans and credit cards and all that stuff. I think the average consumer is screwed. I think people who have money are fine. And I think that's where you're seeing the disconnect. So you've got people, going on the news saying, hey, this economy is great. It's like, dude, you're rich. For you, it is. But bring on, Joe Schmo in some industrial town in Pittsburgh and ask him what he thinks the economy is. It's awful. Now, can those two things coexist? I don't know the answer to that. 2008, everything went down because the housing market went down and that impacted everybody. All right, yeah, I'm rich, but my house that used to be worth $2 million is now worth $500,000 and I'm underwater on a whole bunch of stuff. and stocks are going down at the same time, I'm screwed. If we see a collapse in the auto loan market, that doesn't impact me. Probably doesn't impact you. So I don't know the answer to that. I think we'll find out the answer to that because I don't think the Fed lowering interest rates 50 basis points is helping the guy out there working 3 jobs, paying 20% more for gas and food.
Sure. I got one last question for you, Matt, and I'm excited to ask it. It's my favorite question to ask every master of the market. And for this one, I guess we're sending you back to 8th grade to give you another $10,000 to invest it in the stock of your choice. I'm curious to know, what stock would it be? It's held for the long term. What stock would it be and why?
Apple, because I think Apple will be the ultimate beneficiary of AI. Imagine AI integrated, and people, it already know, not yet. Imagine AI integrated into 1.4 billion iPhones. All of the stuff your iPhone knows and does for you, and now it's smart. I think if Apple, and Apple's got to implement that the right way, but they've done everything, or pretty much everything, the right way up until now. If they implement that the right way, Apple could control the world.
I love the answer. I'm a huge Apple fan. Investors, Mathew Tuttle on with us from Tuttle Capital Management. Go check out the Tuttle Capital Management website for those ETFs that they have over there. I am certain you will find one that will be suitable for your portfolio. Again, all designed based on what you're looking to do. Of course, Mathew's YouTube channel will also be down there in the pinned comment for you to check out. Mathew, it was an honor and a privilege to have you on Masters of the Market with us. And investors, until next time, we will see you all there.